So assuming we can get this whole debt ceiling thing figured out, there's something brewing in the housing market right now that could play a major role into what happens over the summer. And I'm going to talk about that in today's video. And we're going to break down the weekly housing market update from Housing Wire, which is one of my favorite platforms to gather data from. And so if you're not subscribed to them, check them out. They're amazing. So first things first, we have to look at, and then I'll get into kind of what's happening here. But we have to start to look at what happened last week and then what potentially will happen this week that I will make a video on next week. But first and foremost, let's look at the inventory. So if we look at this for last week, all right, we see the change from May 5th to May 12th in weekly inventory change rose from essentially 419,000 to 420,000. Not a big deal. Still really, really low. And we look at the same week last year during the exact same time, and it rose by about 12,000 homes. But you could see we had a lot less homes for sale. And we saw the bottom of inventory in 2022, which was about 240,000. Now, the peak for 2023 so far in housing inventory was 472,000. And I love the context that Housing Wire gives us because we have to say, okay, well, what does this mean? We have to give it something to compare to or context. Well, active listings in 2015 was over 1 million. And you could see this on the graph to see, okay, how does this housing market compare to that of one that was a true housing market bubble or a housing market crash? And you can really look at the data and say, well, wow, the inventory back in August of, late 2015, 2016, it's over 1 million homes for sale. And then you kind of look at where we're at now, and we're still hovering around 420,000 active homes for sale. That is the key thing to this housing market. Well, I should say home prices staying put. They aren't accelerating at the levels that we saw in the past, but they're certainly not dropping the way in which a lot of people predicted that they would this year. Now, the big thing that is happening in the housing market that everybody's talking about is the fact that nobody wants to sell their home. We're kind of like in this gridlock, right? Well, we have to look at, okay, what happened to new listings last week? Well, this week in May, over the past 3 years, in 2023, about 62,000. In 2022, 73,000. In 2021, it was about 71,000. What does this mean? This means that as we know, there's a lot less people, even when we're getting into home buying, home selling season, willing to list their homes. We know that. We understand that is what's happening because of mortgage interest rates. We've got buyers and sellers really on the sideline. And if we just compare this to monthly active listings, this is from NAR, and we look at the graph on screen, even if we go back in time, we could say, wow, look at active listings in 2023 have been hovering under 1 million. This includes homes that are pending and active for sale. And if you look historically, if you go back even further, you start to see, okay, during the 2008 housing market crash, we had about 4 million houses for sale. And now we're sitting here under 1 million. But that's not all. And so the question that we all have in the industry is, well, what's going to happen with mortgage rates? And there's some interesting things happening that potentially can go either one of two ways. There's a lot of people that, based on this whole debt ceiling thing, that if the government can't get this thing figured out, could push mortgage rates up to 8-9%. Some people are saying. And on the other hand, if we can get this thing figured out and the Fed continues to fight inflation with what they're doing, and we start to look at the bond market and the 10-year yield and mortgage rates, here's what is super, super interesting. All right. So it's all about where that 10-year yield will go. And so if we look at this, it all comes down to the labor market. All right. So and I'll just kind of go through this with you guys. If the economy gets weaker, this is what we're trying to help real estate agents understand, meaning that the labor market sees a noticeable rise in jobless claims, then the 10-year should break under 3.21%, potentially going all the way down to 2.72%. This will take mortgage rates under 6%. This can get us below 5% if that trend continues. In other words, this is what I think a lot of people in our industry don't understand is they say the housing market is going to collapse because, Brandon, we're heading towards a recession. If you remove the last recession of 2008, the true housing bubble, the housing market tends to do well during a recessionary period of time because interest rates are low. And as a result of that, all this pent-up demand, both with buyers and sellers sitting on the sideline, if the Fed continues to fight inflation and we see inflation comes down, which as a result, unemployment goes up, well, how the bond market responds to that as we get closer and closer into recessionary times, mortgage rates go down during recessionary periods of time. If interest rates go closer to 5% or they dip below 5% this summer, I think you're going to start to see a true, you will start to see this market move more than we have in the past 4, 5, 6, 7 months. That will be the thing that gets this market really to turn. Because when we start to look at mortgage application data, we start to see that just last week, the data showed a positive 5% print. It's still down 32% year over year. However, buyers right now, even given home prices, even given current mortgage interest rates, they're starting to accept the fact that this is kind of the new normal. But watch what happens if mortgage rates dip. Not only will all the people who have bought a home over the past year at 6 3/4 or 7 1/4, yes, sure, they'll all refinance. But all the people that have been on the sidelines, all these people that are waiting to sell because they're at some ridiculous low interest rate and buyers kind of waiting to see what's going to happen, all these people get off the sideline. And here's the thing. We've got a huge week ahead of us, massive week ahead of us, because there's a lot of big housing data coming up. And so there's a lot, especially for housing, because we have builders' confidence data coming out. We've got the housing starts and existing home sales report coming out. Monday, we also have the New York Fed quarterly credit and debt update. So those are some of the things that we're going to start to look at to see, okay, where are we at? We're going to look at foreclosures and bankruptcies. We're going to start to look at all of that. And we're going to take all of that into consideration to see how the bond market's going to respond. But if the bond market continues to respond to the economy the way that it has been and mortgage rates continue to trend downward, I think that you'll see the number of new listings hitting the market increase. I think the number of people waiting to buy a house increases. But we're running out of time because it's already the middle of May when I'm making this episode. And what I mean by running out of time is we're going to find ourselves in the middle of home buying, selling season. And if rates don't move down fast enough, we could find ourselves getting into the fall market, which tends to not do that well, tends to be a slower time anyways. And we might miss this opportunity for people to transact. And so to get the number of transactions up, But we'll see. This is a big, big week ahead. So I will make another episode here next week to let you guys know what happens.